What is up, everybody? My name is Grant Petrikowski here from Outperform The Market, and I'm so excited to do this video. This is a beginner course for those who want to learn how to trade stocks and how to trade options. Target audience for this video is going to span the range between people who have never touched a stock before, who might not even know what a stock is. Maybe you have somebody who handles your finances, or maybe your company handles it for you with a 401k, something of that nature. But we're gonna get into that. I also want to talk to those of you who currently have made trades before and maybe you're not having much success at it. So everyone on the internet that I see out there posts these technical analysis and chart patterns that kind of paint a picture for what trading entails, but it's not really the full picture. The other half of the picture is how to match an assumption to a strategy and make money off of it. I'm going to show you that other half of the picture here today. That way you have a full picture for what trading the market entails. With technology as advanced as it is today, with the current trading platforms that are available, giving you access to real-time market data, very tight markets, and a variety of different strategies you can use, it makes sense to handle some of your finances on your own. So first we're going to get into what is a stock. A stock price is derived from the market cap, which is the overall valuation of the company, divided by the number of shares issued to investors. So this number is going to be the share price or the trade price. This is going to be the cost to buy a share of the stock. When you buy a stock or go long, you look for the stock to go up in value at a point in which you can sell for a profit. When you short sell a stock or go short, you're selling shares you don't own. They are loaned to you by your brokerage using something called margin, and you're looking to buy these shares back at a lower price. So this is a strategy where you think the market's going to go down. Now, these are two of the simplest ways to play the stock market. So I'm going to show you on our Webull trading platform. So right now we're looking at the stock Microsoft. Now you can see at around May 5th, it was trading at around 302 or a little bit higher at about 303.63. So if you were to buy Microsoft on May 4th for $303.67, you would be able to sell right now at a profit because the share price currently trading at 317 is higher than when you bought it. So that's how you make money buying a stock. How you make money shorting a stock is, let's say Microsoft is trading at 317.33 or like it is right now, and you thought it was going to go lower. So what you would want to do is you would want to sell shares of Microsoft at 317.35 on margin, and you're going to look to buy them back at a lower price, maybe around 308 or 306, depending on how far you think it's going to go. And that's how you make money there. Another thing I just want to look at really quick is this QQQ. This is an ETF that tracks the NASDAQ. So if you wanted to invest in all of the stocks on the NASDAQ, you could buy this ETF QQQ for $334 a share. So that's just another way to further diversify your portfolio if you wanted to have some stocks mixed in with some ETFs. Either way you do it, you are trading the notional value of the underlying asset, being whether that be an ETF or stock. So that's one way to trade the market. So as you saw when we were trading the stocks, it's pretty expensive to buy a share of Microsoft. It's $300, and if you're gonna have that gain that we saw going from 305 to 327, I think it was, that's like a $22 gain for that whole span of like this past month. Well, that's not really that good. The other problem there is that if Microsoft has a massive downturn, like the stock just crashes, you're going to take a pretty significant loss. So I want to offer you a different strategy to trade the market. It's something called options. An option is a contract between two parties, a buyer and a seller, for 100 shares of the underlying asset and costs significantly less than buying 100 shares of the stock. Now, these options can make you a lot more money than buying the stock using the same amount of capital you would have used to just buy the option. So what's the catch? Well, there are a few factors associated with options that you need to know when you get into trading them. The first one is time decay. So holding an option is like holding an ice cream cone on a hot day. If you hold a long option and the stock does not move, the option decays in value at a rate that is set by the option's theta. Another factor that affects options prices is the implied volatility of the underlying asset. The implied volatility is the expected move of the underlying asset up or down within the time frame in which you're trading the option on. Now, this is determined by recent price activity. The implied volatility of a stock will increase during events such as earning reports, market crashes, when the Fed announces that they're hiking interest rates. So what you really need to take away from this is that option premium, which is the price you're paying for the option, increases when implied volatility is higher. So two things I want to let you know about options that are pretty important to know, and maybe I'll go to our options trading platform to demonstrate this one. So we're going to take another look at QQQ here. This time we're going to use the Tasty Trade platform. This is what I like to use to price out my options trades before I place them. So this is what an options chain looks like. You have all your different expiration dates of all the options. You have the days until expiration. If you open one up, so let's go 24 days to expiration, June 16th. These are all your different strike prices that we talked about. So on your left side, you have calls, and on your right side, you have puts. So if you're going to buy a put will make money when the stock goes down. A call will make money when the stock goes up. Now, barring all of the the catches that we talked about, such as time decay and implied volatility. So I'm going to put on data so you can see that here. So this is how much every day your option is going to go down. Now, one thing I need to point out is that when you buy, say, a 334 call here, it says its price is $6.96. But since options are contracts for 100 shares, this is actually going to cost you $696 to buy. So just remember that it's similar to buying a stock, but you're getting 100 shares at $692 you're paying total. Each share is worth $6.91.